Hello and welcome to Need to Know, your weekly investment podcast brought to you by the experts at Coutts. I'm Sarah Muir and I'm joined as always by David Broomfield. Hi David, how are you?
Hi Sarah, I'm well. I'm keeping warm.
Good, yes. Well, it's been quite chilly, but we're not here to talk about the weather. We're here to talk about markets. And before we get to talk about markets, quick fire numbers round. What is your number this week?
Well, it's a non-weather related number, isn't it? Yeah, my number is 40%, which
40%, okay.
Which was the composition of car sales in China that were EVs.
Wow.
Right. So let me just give you some international comparisons. So that was last year, 2023, 40% of all car sales in China were EVs. How does that compare to the US?
Yeah, that was my question.
Only 10% of cars sold in the US were EVs. Now, what was interesting when I dug a little bit deeper into that stat, if you look at truck sales in China, in 2016, about 98% of trucks were diesel. Last year, 2023, barely above 50%. So like all things in China, A, the numbers are massive, and B, the speed of transition is just astonishing. So, you compare that to other markets and it sort of, it just dwarfs other markets in the rate of change.
I wonder how much that relates to the number of electric vehicles that are produced in China compared as a proportion of cars and vehicles manufactured compared with other countries. I appreciate I'm probably putting you on the spot. That's maybe a little bit of homework for you, David.
Well, yeah, look, I mean, the absolute numbers are massive, but you can't escape the percentage numbers. And the point is that when it comes to building EV infrastructure and actually EV R&D, China is leading the world here. The pace in which charging infrastructure has been laid down, is astonishing, certainly compared to the US and other major markets. And I think I mentioned on the pod earlier this year that BYD, the largest car company in the world you've never heard of,
exactly,
has a hybrid vehicle, so it's electric and petrol, that I think can do 2,000 kilometers, and you can buy it for around $13,000.
Okay, that's suddenly sounding quite attractive.
Well, yeah. I mean, obviously, we won't see any of these vehicles over here because both the European Union and the US have obviously, through trade protectionism, effectively blocked them from the markets. But fascinating nonetheless. What's your number? Come on.
My number is £993,816.
Well,
I've gone for an esoteric number this time. I've taken a leaf out of your book.
Yeah, but it's an incredibly precise number. So someone's put a lot of thought into that number. Go on, let's tell everyone what that is.
It relates to something I saw in the news this week, and that is the fact that Smithfield Meat Market is going to be finally closing for business in 2028. And that was the cost of the construction of the new market buildings in 1866, £993,816.
Wow. And one of the last sort of centralised markets, right?
I think it must be the last one because Billingsgate's already moved out. So I think Smithfield is the last one. And interestingly, there seem to be various dates, but there's been some sort of livestock or meat market on that site, certainly since the early 14th century. Originally, it was a livestock market and you would have brought your cattle and sheep and horses or whatever, fatten them up, sell them there. And then and that live cattle market actually moved to Islington, of all places.
Wow.
In 1852.
Well, I suspect a lot of these sort of centralisation initiatives were, I mean, obviously, anyone that's a student of history will be familiar with the term shambles, which is where obviously livestock was taken prior to slaughter and market. And it was a very sort of disaggregated system where there were lots of these little mini livestock markets all over towns, cities, and even villages. Most of the centralization of these kind of markets comes back to regulation, which is a pseudonym for tax. If I can put it all in one place, I can tax it.
Yeah, it's much easier.
And Henry II was he was all over that. That was a great way of raising money.
Okay. Well, there we go. So a prime sort of area for real estate development, I imagine, Smithfield.
Yeah, well, Billingsgate moved out and it's probably going to move again, right? I mean, no one really wants a fish market next to their very expensive condominium or apartment.
No, exactly. All right, then. So we're not talking about meat markets today, but we are talking about, well, what are we talking about, David?
Well, I can shamelessly link the two. So a big portion of the CPI, not necessarily the PCE, so the personal consumption expenditure index that the central banks are interested in, a big portion of the CPI, the consumer price index, is meat, is food. So I think we need
Definitely
to talk about,
David.
Thank you very much. We need to talk about inflation today. So we need to, obviously there's been some, I'm going to say, hot inflation prints. Certainly, I think stronger than some people are expected. But I think, as I'll explain throughout this discussion, that actually it's not that surprising. So we'll talk a bit about inflation. Let's talk about what it is, what the impact, perhaps some of the inflationary and tariff expectations might be next year, and where we'll end up with rates. I think that's the way to break it down.
Okay, brilliant. Right then, let's kick off then with inflation. What's happening? Why it was meant to have gone away, wasn't it?
It was meant to have gone away, and by and large, it has gone away. I mean, there's been a global trend of disinflation, but I suppose there are pockets of stickiness. And if you look at the world today, just take a snapshot, plenty of the world is in this disinflationary rate cutting mode. So Latin America, South Korea, they're aggressively sort of cutting rates. I talked about this before. I mean, Brazil was one of the first banks to raise rates. Disinflationary trends are sort of healthy and alive there. It's really about the US and the Eurozone. That's getting all the focus, and the UK as well, where inflation is a bit more sticky. But before we talk about inflation trends, let's just remember what we're talking about here, because I've been quite vocal about this on LinkedIn, that you and I and everyone that listens to this pod will be very interested in inflation levels, just how expensive stuff is.
Yes.
Relative, because it's a relative point, relative to their real incomes, what you earn. Yeah. So CPI is how we think about inflation, and that will track, the average price of changes in a basket of goods that are typically consumed by households. And in that basket of goods are things like food and energy and the more kind of volatile parts traditionally of inflation. I went digging around actually in the CPI indices. It's been I'm ashamed to say, a good decade since I've gone in and actually looked at what's in it and the percentage weightings of it. And, these indices are quite often backward revised, and they're updated to reflect trends. I mean, a decade and a half ago, DVD players were a big component of the CPI, but no longer, obviously. But a colleague of mine at the bank was saying, during the pandemic, hand sanitizer was a big component of the CPI. Yeah. So these things are dynamic, but they tend to be more volatile. That's the bit that we care about. The bit that central banks care about is this thing called PCE. And that's what the Fed likes. It captures a much broader consumer spending pattern than just like these sort of CPI baskets. So of course, economists will come in and they'll create different definitions. So it's not just CPI and PCE. You have this thing called the GDP deflator. I'm not going to go into that here, which measures broad price changes across the economy as well. It's a different macroeconomic view. And why are these definitions important? They're important because central banks might focus on one measure, but that might not reconcile with how households feel.
Yeah, which we talked about with the anti-core CPI basket we talked about in a previous episode. Okay, we did have US PCE out this week. And as you said, certainly as far as the Fed's concerned, it's their favoured metric. So what was that looking like? Was it up, down, in line with expectations?
So big picture, okay. So remember 2 years ago, it was about 2 years ago last summer, the PCE peaked at around, I think, 5.6%. That was its peak. And it's most of the way back to the Fed's sort of 2% target. So the progress this year has been quite modest. Remember, I think I talked way back this year, and I've written about this idea that actually the big gains in disinflation were quite fast, and then the bit that towards 2% is going to be quite slow. So we've had modest disinflation this year, and the print in October was a little bit stronger. It's probably the strongest print we've had since April this year. So up 0.3% to 2.8%, which is the fastest rise since around April this year. So the US situation, should we talk about why that is? Because your initial question was, we thought this was over, but there's a couple of components to inflation, okay? And then the US situation is very different to the situation in the UK and Europe. So the US situation is about a buoyant economy. And the stickiest components in their inflation index are the ones that are actually the most lagging. So first of all, the economy in the US is doing very, very well. That's point one. And also then point two is these sticky components like insurance payments, insurance premiums, shelter costs. That's about a third of the inflation index. They tend to be much slower to adjust. Now, there are ways that economists and analysts can look at real-time rental costs. So you can go onto any one of these online rental markets in the US, and you can see what shelter costs are, and you can see that the numbers have come down. The index doesn't yet reflect that. And most of the investment banks think that eventually the index will catch up. So this little blip that we've had recently is more about strong consumer spending, sticky sectors, service sector inflation, the sectors I've just mentioned as well. And there's the other side of this as well, which is expectations. Now, I'll come on to expectations in a second, but the UK situation is different to the US situation. The UK situation is more supply side. It's about a bit of Brexit, a bit of weak productivity growth, and a bit of energy that has basically impacted overall, disinflationary trends here in the UK and to a greater extent Europe as well. So it's not about just sort of demand side, momentum like it is in the US. It's more about supply side factors.
Okay. Now you talked about tariffs and expectations. Now we are seeing that potentially, I think, aren't we, as part of the issue, perhaps being reflected certainly in bond yields, aren't we?
Yeah, I mean, this is the interesting thing. So if you look at nominal yields on like a 10-year, treasury or something, you can then break down, well, what's driving that? Well, you've got inflation expectations, which are measured by these things called break-evens, and then you've got sort of the real yield on tips. Okay, so you've got.
So just explain what tips are for those that don't know. Yeah,
they're basically. Well, we'll start with break-evens first. So that's the difference between like a fixed return and inflation-linked return, and then the real yield on tips is basically just a different measure of what investors need to be compensated with to adjust for inflation. Okay, that's probably the simplest way to explain it. I mean, the reason I'm breaking this into sort of two components is the tips component is really focused on this economic momentum point, this point that the US has just been very, very strong, and therefore central banks might not be able to cut rates as quick as they can. The bond market's basically saying to central banks, your job's not done yet. Yeah. This break-evens point is more about sort of inflation expectations. So as I said, real yields are about growth expectations. Break-evens are really about expectations, and there's some liquidity factors about the bond market in there as well. But really, I think this is about tariffs and the fact that I think well, it's not just tariffs, it's also the sort of expansionary policy mix that we might be expecting from an incoming administration next year. And so both of those subcomponents combined kind of give you this nominal yield, which has gone up. Okay, long explanation, sorry, but there's lots of things driving this, not just one thing. So it's not just about tariffs. It's about the fact the US economy is very, very strong, and we could have a policy mix that comes in that further adds fuel to that, but also some sort of asymmetric sort of price shocks through tariffs. So it's kind of a combination of factors that are driving that nominal yield higher.
Okay, so it's a combination of some lagging factors, robustness of the economy, resilience of the consumer, plus some expectations about what might happen when we get a new president next year. We haven't talked about Europe. What about Europe? Because Europe, I mean, I read the other day that the Fabio Panetta, governor of the Bank of England, is calling for faster rate cuts. And there's something like a 60% probability of a 50 basis point rate cut next month by the ECB. But it looks like we might not get a rate cut from the Bank of England or the Fed.
Yeah, I mean, okay, so the Fed now is, if you look at what this has done to rate expectations. So the December rate cut was never certain anyway. I mean, Powell almost said that verbatim. And if you look at the odds of it, it's a little above evens now for December. But I think when we come on and talk about terminal rates, I think I'll make the case that actually the destination is the same. The pathway now is perhaps slightly different. It's not about sort of incremental cuts now. It might be more later, as opposed to spread more evenly between now and then, now and terminal rate. In Europe, though, yes, the situation is a little bit different. There's more of a tug of war, I think, between parts of European economy. I mean, you look at German manufacturing as an example, or even in the UK economy, there are parts that are more, I think, aligned to a slowdown narrative. That's not the same for the entire UK economy. But then, the Bank of England is also looking at service sector inflation, which is really sticky and showing quite a buoyant service sector. So I think European central banks, and I'll put the UK in that bucket as well, have a much more difficult job between slowdown and managing inflationary shocks. I think the US situation is more straightforward, but there's a wild card in that we don't know yet for certain what the policy mix is going to be next year. I mean, nobody knows yet what an incoming Trump presidency might entail. And I've seen loads of analysis by the investment banks that build these very complex models on what that might be like, and they're based around lots of assumptions. But the point is that these relationships probably aren't very stable. Trump is kind of mercurial. We just don't know yet. Whatever these models might say about inflation next year driven by policy, we're just not sure.
Okay. Before we get on then to the impact of what may or may not be introduced next year, I wanted to just draw everyone's attention to, you were talking about that sort of movement of the yield on the 10-year Treasury. There is a chart of the month, which I believe you've probably shared on LinkedIn, I think, haven't you, where people can actually see that, and you can see that difference between sort of real yield and break even and all those kind of things.
Yeah, exactly. That's on the Coutts LinkedIn page. It's also, I've reposted as well. It's on mine for anyone that wants to listen to it. So let's just dwell on what the bond market is saying now. Let's try and summarize that. I mean, the bond market is watching two major sources of inflation, right? It's basically deficit spending and the money supply. You've got all these factors I mentioned, but those two are deficit and money supply is really key here. And when you look at the US as an example, and this is particularly relevant to the policy next year, deficit expenditure isn't, I think, as straightforward as people think. Okay, so it's, first of all, it's very unusual at this stage in the economic cycle, in an economic expansion, to have a $2 trillion deficit. That's point one. And there doesn't seem to be a revenue problem. If you go and decompose US tax receipts, they're 60% higher than what they were 10 years ago. The spending is 93% higher. So I talk about an expansionary policy mix next year. Well, look, we already have that. But I think the market is saying, well, even that's probably not sustainable. And now you're thinking of an even greater expansionary policy mix. So I think that's part of the story here, why yields are ticking up, because that would ultimately increase inflationary pressures. And I think that the tariffs point, well, we'll come on to in a minute. I think that can be argued both ways, and we'll come on to that in a second. Basically, the two components in the chart: real yields, break evens, they drive the nominal yield up. Go and look at the chart. I think that tells the story.
And in a nutshell, markets are saying, the Fed, you're not done yet. Work still to be done.
Work still to be done. Yeah, exactly.
Okay, all right. And we'll come back to what that work is to get to terminal rates in our final point. Okay, we've got a new president. He's going to be inaugurated 20th of January, 2025. I've seen lots, and you've seen probably even more than me, a lot of sort of content written about the impact of his policies. I guess predominantly tariffs, but also immigration, and how that is that going to add fuel to the inflation fire, essentially?
Yeah, this is super interesting. And I'm afraid to say it's actually really complicated. Like these policies don't exist in a vacuum. So global trade is massively complex, and to apply tariffs to just one component of it can have far-reaching consequences. So first of all, big picture. Okay, US tariffs have been basically under 4% for around 3 decades. And under Trump, that number could, if you take all the investment bank research and look at what was said on the campaign trail and what potential policies have been proposed, and then apply that to a number, you could see the tariff number go from sort of 4%, where it's been for 3 decades, to around 20%.
Yeah.
So that's big. But what does that actually mean in practice? Now, there was a lot of talk earlier on this week about Trump's view of putting 25% tariff on goods from Mexico and Canada. And here's why it's complex. So we all know that the US is a net exporter of global energy, of oil. But also it's a massive importer of Canadian oil.
Yeah.
Well, how can you be energy independent and an energy exporter, but still import oil from Canada? And this is where global trade gets complex, because that says about comparative advantage and why nations trade with each other. And you can't just look at the aggregate numbers. You've got to look at individual supply chains and individual markets. And the reason that the US imports oil from Canada is quite straightforward. That all the refineries in the northwest of the US have invested so heavily over the last 5-6 years to convert to refining a particular sour, heavy type of Canadian oil, that they don't refine the oil that comes from Texas. So if you slap a tariff on Canadian oil and all of a sudden it becomes expensive, those refineries can't just refine Texan oil. They have to look globally to find that same type of oil. Yeah. So net, what I'm saying is, in that example, it probably is inflationary, but not in all examples.
I saw a figure that Canada supplies something like at least 50% of crude oil imports into the US.
Well, I think that number is a bit higher than the number I had, but it is material. It's massive. Yeah. It's about a couple of million barrels a day go through these pipelines, and they're hardwired in. It's not like Brent that's floating around the ocean. These pipelines are deeply political things, and they're huge sunk costs for decades. The thing about tariffs, though, is that their impact is complex. So what we know is that if your market is in a disinflationary trend, so let's take as an example, there's a fantastic chart, which I'll tell you what, I'll post on LinkedIn, which shows washing machines. Okay. Now, washing machines have been a disinflationary trend for decades. So what it costs you in real terms to buy a washing machine today is a lot less than what it cost you in 1990. Yeah. If you slap a 20% tariff on washing machines, and this is real data from the US under the first Trump administration, you basically see a parallel shift in that disinflationary trend. Okay, so you get a one-off price increase of 20%, but then the disinflationary trend continues. Okay, so I want to differentiate here between a type of inflation that's just a price shock, which is what a lot of these tariffs are, and the type of inflation which is a wage price spiral. Okay, so when you said right at the beginning, isn't this over? Hasn't inflation gone away? This is the point, that accelerating inflation, where inflation leads to wage increases that then drive inflation further. That's not what I think we're experiencing here, because if you look at price level growth and wage level growth, it's clear there's not a problem with wage level growth. And similarly with tariffs, you're not going to get this sort of this flywheel effect, this accelerating effect, but you get effectively a price shock. Now, what does that mean in reality? It means that people are poorer because individuals pay more money for goods that they would otherwise. And yes, there are substitution effects, and it's more complex, David, than just this simple example. Yeah. But generally, as we all know, people pay for tariffs, so you get poorer. And one final data point, go and look at the previous examples of what tariffs did. In 2017, the Trump administration imposed tariffs on Canadian lumber. Lumber prices rose sharply. Okay, I mean, this is quite a homogenous good, right? You can buy lumber from anywhere. But the short-term effect was that it added about $9,000 to the cost of a home in the US. And those higher construction costs then contributed to inflation, reducing affordability, et cetera, et cetera.
Yeah, on that sort of related theme, I saw there was some research done by the Peterson Institute for International Economics, and they said that tariffs will add over $2,600 to the annual costs for a typical American household. And then, but on the flip side of that, or not on the flip side of that, but the impact on GDP, I saw the Wharton Business School have said it could reduce GDP by 5% over the next 2 decades. Now, that seems like quite a long timeline to be looking at.
Yeah, I mean, you can argue about the numbers, but I think every economist out there would say that they have a negative effect on overall growth. They're effectively a tax on the consumer. And we're in a consumption-driven cycle right now where the consumer is driving this cycle. And it's not a credit cycle, it's a consumer cycle. So we shouldn't trivialize the impacts of them. But there's lots of ways to mitigate it. And this is my point about it being just really complicated. So you've got lots of examples over there around the world. And remember, we've been through this before with the first Trump presidency of reshoring exercises. Okay, that is quite a big decision for a company on the basis of one administration. And remember, tariffs last time were issued by executive orders, which disappeared when Trump left office, although Biden continued most of them through. And if you're going to reshore your company, you're making a structural decision to wholesale move back to the US. That's quite a big decision, but that is one way you can mitigate it. You can obviously diversify your supply chains, and Tesla did this extensively in the last Trump administration to try and remove dependency on China. I mean, what's making a lot of news this week is Hasbro, because obviously Christmas is coming and people are buying toys. And I would say, just irrespective of tariffs, I'd say there's no way that toys are going to be made in the US again. I'll go way out on a limb and say that. And what you saw last time was Hasbro shifting production to Vietnam and India to avoid Chinese tariffs. And, you know, Hasbro, again, to use that as an example, they renegotiated with suppliers to try and split the costs of tariffs. Okay, anyone that's bought a Jenga set in the last couple of years, go in the cupboard and find the Jenga set you never knew you had from 20 years ago and look at the difference in the wood. Boring fact for you here, but the wood now that's in a Jenga set is all cut from the same type of wood from a source that's been diversified away to protect it from tariffs, whereas previously wood was sourced from all over the world and some of it from China. So, you know, there are ways. What I'm trying to say is that there's also political lobbying. Apple did that very extensively in the first Trump administration. There's lots of ways that you can mitigate tariffs. So I don't want to trivialize them, but I don't want to also say that, my word, there's this huge inflationary shock coming. It's really complicated is the answer.
And obviously, presumably, the wherever the US dollar is at any given time, how strong the US dollar is, that's going to have a part to play in mitigation as well, isn't it?
Well, yes, exactly. And I think I sort of think about it actually from the other side. If you consider bilateral trade between the US and China and how China manages its exchange rate, it's effectively a pegged exchange rate within a range. We have the potential for devaluation of the Chinese renminbi. And also, you know, there are other, as I said, these things don't exist in a vacuum. There are exchange rate fluctuations that can impact the incidence of tariffs, because also what's going on the fiscal side will have a bearing on the exchange rate as well. So I think what we have to say is nobody knows. The models that I've seen, and I tell you what, there's some incredible, impressive modeling that's happened by the investment banks to understand tariffs. But the clever people who are far cleverer than me that do those models have come out and said, we're not even sure this is relevant because we just don't know. We just don't know yet whether the rhetoric will meet the reality.
Yeah, I was going to say, and the fact is, we don't know what policies are going to be introduced. We're basing this entirely on what was said on the campaign trail, which we know from previous experience doesn't necessarily, whoever the candidate is, reflect actually what they do once they're in power, because other forces come to bear. And as you say, the sort of strong lobbying in America will say, that's not such a good idea. Can we not do that one, please? Because that's going to impact our business.
Exactly.
Okay. All right, then. So we've talked about inflation. It's ticking up. How that's going to maybe play out with sort of central bank policy. Well, let's come to that now. So we've talked about, you know, some of the things. One of the things that markets are looking at is this potential impact of tariffs and how, and as you say, smarter people than us have looked at it and they can't be absolutely sure how this is going to play out because it's so complex and there's so many interdependencies. So let's get back to the kind of the nuts and bolts of central bank policy. What are terminal interest rates going to look like? Because obviously we're not going to go back to zero or negative interest rates, one assumes. And when are we going to get there?
Okay, let's start with the big picture and then we'll get into the actual pathway and what the market is pricing. So the big picture here, I think, is that we've just lived through a very peculiar decade where interest rates have basically been in the 0 to 2% range. That all ended after the pandemic. And we're now probably in a period, I won't say how long because nobody knows, where interest rates are likely to settle in the kind of 2 to 4% range. Why do I say that? Well, the trends that drove disinflation over the last 10 years, let's say, or certainly since the financial crisis, sort of financial repression and globalization, they're not really driving inflation in the same way that they did. I think everyone recognizes that globalization has, I'm not going to say stalled, it's now different. It's more, it's not quite just, China exporting disinflation to the world. It's more complex than that for all the reasons we just discussed with supply chains and tariffs. So terminal rates, and for those, sorry, that don't quite, aren't familiar with the definition, the terminal rate, what we mean by that is the sort of lowest interest rate that central banks will end up at, that is aligns with monetary stability and encourages growth whilst keeping inflation in check. It's your kind of Goldilocks point where rates settle. Obviously, that's important because that borrowing cost influences consumers and businesses, et cetera, et cetera. And if you look at the bond market dynamics, first of all, health warning, bond markets have been incredibly volatile the last couple of months. And there are a couple of factors that play there. The radical shifting in inflation expectations because we've got a hot economy and this uncertain policy mix next year that I mentioned. But if you look at the big picture, again, the 10-year Treasury yield has declined. A big picture, okay? And then big picture, you've sort of seen this sort of partial steepening of the yield curve, so long yields falling faster than short yields. So the market still expects the Fed to lower rates in the short term to kind of align with those long-term expectations. And if you look at where the Fed is suspected or expected to end up, you're looking at somewhere between 2.5% and 3% by the end of 2026. Sorry, 2020, so into 2027. And as I said already, the chance of a rate cut in December now is a little better than evens. And it might not, the Fed will be data-led, and we might not see a rate cut for a number of months into next year until the policy mix is certain and the Fed has more data. Now, the Fed will be getting more data very shortly, almost imminently, on the US economy. So we'll have to see what that looks like. I think that will inform their December likelihood of a cut.
Yeah, but as you say, certainly expectations have changed. I saw that I think back in September, investors were kind of betting that rates would have fallen to 3% by the end of 2025. They've now shifted that expectation. So they expect rates to maybe be at 4% by the end of 2025. So there's a big shift there, isn't there, in what people think is going to happen?
Yeah, exactly. And this is the stickiness of inflation point. As I said, it doesn't change the destination, it changes the pathway. And there are, and these are they're probably more volatile markets than I've known in my recent career, in terms of how much treasury markets are moving around. So there is also another possible outcome, which is, although there's no signs of it at the moment, that we get the same number of rate cuts, but we just get them much later on in a shorter sequence. Okay, so my point is that if economic growth does stall, I would expect more rate cuts more quickly. But currently, there's no sign of that. So on the basis of where the market is at the moment, you're quite right. I mean, the UK situation is pretty similar. We end up at a terminal rate here of around 2 to 2.5%, as opposed to the US 2.5 to 3%. But you've seen the 10-year gilt yield fall, and the market is probably starting to anticipate earlier rate cuts in the US due to the different growth prospects in the UK versus US.
I guess the wild card in the UK is we don't know yet what the changes to national insurance contributions, employer national insurance contributions, could make. Do we have to see how that plays out next year, I guess?
Exactly. I mean, there's how they ultimately land into the real economy is it will guide the Bank of England, guide the MPC. I mean, the MPC has been so focused on service sector inflation. I think that's the component that I would watch with some detail, because I think that's what's really guiding their decision making right now.
Okay, so I suppose to sum up, then, I mean, we've talked about the potential impact of what the new president in the US may introduce next year, and that's all speculation at the moment, and lots of clever people running numbers through computers, and they're coming out with various different scenarios. But what we know at the moment is we know where we are at the moment. We know we've got sticky inflation certainly in the US and the UK, to a certain extent in Europe, for different reasons. In the US, we've got a very resilient consumer, robust economy. We've got some concerns about what might happen with tariffs going forward. In the UK, certainly, we've got services inflation is a big factor, I think, isn't it? Wages inflation, energy, obviously, the energy price cap was raised, and that was part of the reason why we saw that uptick in CPI this month from, was it 2.3 to 2.7%? But the fact is, so what we're saying is that it's not unusual for inflation to come down in this way. It comes down the rate at which prices go up comes down quite quickly at first, and then the last bit can be quite slow.
Yeah. To put it another way, don't convince yourself it's a nice sort of linear or gentle glide path down. There are big lumps along the way. Sometimes there are outright sort of speed bumps and reversals. The overall trend is still disinflation, but again, what we're arguing about here is the length of time and the components that are lagging.
Yeah. So it's about taking a step back and perhaps not being quite so focused on the month-on-month number, but taking a step back and going, right, okay, we went up a little bit last month, but if we take a step back and look, as you say, the overall trend is going down. And we are heading towards terminal rates, whatever they may be, 2.5%, 3%, we don't know exactly yet. When we'll get there, we're not exactly sure yet, but we will get there within the next, I don't know, year and a half.
Yeah, and, I say this as someone who was resoundingly in sort of team transitory.
Yes.
The kind of experience that we had in the late 70s where you have wage price spirals is not what is happening here.
Yeah.
Okay, so you've got to look at wages and the ability. We've had some really idiosyncratic wage negotiation and wage market activity since the pandemic because of the pandemic.
Yeah.
I would say now that labour markets have kind of returned to normal, and we don't have structurally the same labour market as we had in the 1970s with COLA agreements and unionisation and the ability to bid up wages continually. So inflation is a sequence of shocks, I think, at the moment, and lags.
Yeah.
And the wild card of policy mix.
Yeah.
It's not an accelerating flywheel that we had before.
Okay. Well, that sounds like a reasonably positive note to me, which is probably a good note to finish on. A reminder that the views expressed in this podcast are not intended to constitute investment advice, are accurate at the time of recording, and are subject to change. Thank you, David, for joining me today, and thank you for listening. Until next time on Need to Know, bye for now.